Hello, bonjour, hola, namaste. Welcome to Quant Investing for Portfolio Managers, a course designed to equip you with cutting-edge tools and techniques to build smarter, data-driven portfolios. As a portfolio manager, your goal isn't just to chase returns, it's to craft portfolios that deliver consistent performance while managing risk effectively. But let's face it, relying on gut feelings, headlines, or influencer tips doesn't cut it in today's complex markets. That's where quantitative or quant investing steps in. But why should you move towards quant investing? Quant investing takes the guesswork out of investing by leveraging data analysis, uncovering hidden patterns, and applying mathematical models to optimize portfolios. Think of it as a powerful toolkit that aligns with your objectives. For example, imagine you're managing a portfolio during the pandemic. While the headlines were chaotic, quant investors used data like mobility trends, supply chain disruptions, and sector-specific recovery patterns to identify opportunities in tech and healthcare early. This course focuses on factor investing, a proven methodology used by legends like Benjamin Graham, Warren Buffett, and Charlie Munger. We'll delve into traditional factors like value, momentum, quality, and size, timeless principles that have guided portfolio managers for decades. Non-traditional factors, where innovation thrives. From satellite imagery to sentiment analysis and even return skewness, we'll explore how unconventional methods can give you an edge. We'll guide you step by step through the process of building a factor portfolio. First, you will quantify factors. Let's say you are creating a portfolio based on the value factor. You are going to check the price to earnings, or PE ratio, of all the stocks in your portfolio, and classify a stock as undervalued only if it has a PE ratio of less than 20. For example, a PE ratio of less than 20 for Meta platform in December 2022 would have made Meta an undervalued stock. But you will not stop at only traditional factors. You will try to generate extra alpha in your portfolio by looking at non-traditional factors which are not as well known. Further, you will explore multi-factor portfolios. Why settle for one factor when you can combine several? You'll learn how to balance factors intelligently, moving beyond equal weights to optimize portfolio performance. Apart from value, you can look at momentum factor. In 2024, Nvidia exhibited a strong momentum in its share price and would be included in a multi-factor portfolio. Then you will look at factor timing. Economic cycles impact factor performance. Some thrive in growth periods, while others shine during recessions. You'll discover how to time factors to ensure your portfolio stays resilient. Finally, you will apply factor tilting to your portfolio. Using performance metrics, you'll compare factors and adjust your portfolio dynamically, tilting towards factors with strong performance. The job isn't done once the portfolio is created. You'll evaluate overall and individual risks. This isn't just theory. You'll gain practical experience with Python notebooks, enabling you to design and implement your unique factor portfolios. By the end of this course, you'll have accomplished the following: finding an edge through non-traditional factors, timing factors, tilting portfolios towards high-performing factors based on performance metrics, assessing portfolio risks. Ready to take your portfolio management to the next level? Let's dive in and start building smarter, more resilient portfolios today.